Bell, Morgan Stanley's Mike Wilson today says of what Jim's talking about in terms of the bear market. He says the bear market's ending. He says this is the best risk-reward market in 2 years. Do you agree?
I think I agree with Jim in that I think there is opportunity at these levels, but I'm not certain that the bear market is over. Look, if I look back to 2008, I know that we saw two bear market rallies of 18% plus at the end of 2008 before we bottomed in March of 2009. So what I think you're seeing this week is a little bit of optimism about how we can get through this crisis with the backing of the Fed and the backing of the government with this big fiscal stimulus plan and potentially more to come down the road after Easter. But I think investors are, while they're getting a little bit more comfortable with Q2 being extremely weak, I think they may be a little bit too optimistic about that recovery in Q3 and Q4. We don't exactly know where earnings are going to go from here, and I think that it may be a rude awakening in mid-April when we do get that peak in coronavirus counts here in the U.S., and we're starting to get into earnings season, and we're starting to hear from management teams that the quarter was bad, and they're withdrawing and suspending their outlooks, and we just have no clear sight down the road.
But, Joe, we know the lights are going to come back on, right? The switch on the economy was turned off because of what we're dealing with the virus, and at some point, the switch is going to get turned on, though I think you can make a credible case that it's going to be on a dimmer, and it's going to slowly get up to full light. It's not going to be a flip of the switch and you're back running as normal before. So how do you factor all that in as you're trying to price stocks today and what future earnings may in fact be?
Well, you make the assumptions that risk assets have discounted a lot of the negative news. As example, just look at the claims figure that we got this morning, and the market responded by going higher. I would say this, you have a situation where you've got the investor community, and in the multiple client conversations that I'm having, and I'm sure that everyone on this committee today is having, most investors are sitting in their seats. They are riding through this volatility. They're worried about their families, and they're worried about paying bills. The other side of that is the trading community. And this is a trading event, and markets are responding in that trading event to two things, in my view. Number one, they're responding to a massive rebalancing that's going to come at the end of the quarter out of treasuries into equities. Number two, they're responding to a very powerful technical formation that we last witnessed in 1932. If you go back and you study the week of July 5th through July 15th of 1932, you'll see the technical formation of what's known as an outside-up reversal week. Now, if Paul Tudor Jones is listening to this show, if Lizanne Saunders is listening to this show, if Jim Cramer is listening to this show, they know exactly what I'm talking about. We have that formation this week, and the trading community is reacting to that. We came in on Monday, we traded below last week's S&P 500 low. We are now trading above last week's S&P 500 high. So I said to you yesterday, Scott, the hardest trade to make is usually the right trade. And I agree with everyone's assessment. There are many headwinds to come in the earnings and economic numbers. But right now, the trading community is responding to those two bullish catalysts.
Okay, I'm going to take